Amazon stock falls 7% despite earnings beat. AI concerns and murky guidance explained. Here's a shocking truth. Amazon stock took a nosedive despite beating Q2 earnings expectations. And this is the part most people miss. It's all because of murky guidance and growing AI competition. But here's where it gets controversial. While the tech giant's net sales soared to $167.7 billion, a 13% increase, and earnings per share smashed estimates at $1.68, investors are worried about the company's vague AI strategy and weak profit outlook. CEO Andy Jassy tried to defend their AI plans, but his lengthy responses left analysts and investors unconvinced, sending shares tumbling 7% in after-hours trading. And this is the part most people miss. Amazon's AI ambitions, including Alexa Plus and Project Kuiper, are bold, but face stiff competition from the likes of Elon Musk's Starlink. The company's operating income guidance for Q3, ranging from $15.5 billion to $20.5 billion, fell short of analyst expectations, further souring the mood. During the earnings call, Jassy highlighted Amazon's resilience against tariffs, pointing to strong Prime Day results, but admitted uncertainty about who will absorb higher costs. The call also revealed challenges in AWS's AI infrastructure expansion, particularly electricity and chip procurement, which could take several quarters to resolve. Amazon's AI investments, totaling around $105 billion in 2025, are significant, but returns may not be immediate. Analysts like Justin Post from Bank of America and Brent Thill from Jefferies remain optimistic, seeing AWS as a key growth driver and Amazon as a leader in e-commerce and AI. However, the question remains, can Amazon maintain its edge in the AI race? This is where opinions diverge. Some believe Amazon is undervalued and poised for a comeback, while others worry about its ability to compete with rivals like Microsoft. What do you think? Is Amazon's AI strategy a game changer or a cause for concern? Let the debate begin. Amazon AMZN stock crash. Why AWS results spooked investors. Imagine a scenario where one of the tech giants, Amazon, faces a significant setback that sends shockwaves through the financial markets. But here's where it gets controversial. Amazon's cloud computing division, AWS, didn't quite hit the high notes investors were hoping for, leading to a dramatic drop in stock prices. Shares plummeted by more than 7% in after-hours trading, despite Amazon forecasting third-quarter sales above market estimates. To put this into perspective, while Amazon's cloud unit reported a 17.5% increase in revenue to $30.9 billion, surpassing expectations of $30.77 billion, it paled in comparison to the impressive performances of rivals like Microsoft and Google Cloud. Microsoft's Azure saw a 39% rise in sales, while Google Cloud gained 32%. This disparity is crucial because AWS is often seen as Amazon's growth engine, and any dip in its performance can significantly impact the overall stock price. The margins for AWS also took a hit, narrowing to 32.9% from 35.5% a year earlier. This is the lowest level since the final quarter of 2023, which raises questions about the sustainability of AWS's profitability. Ken Mahoney, CEO of Mahoney Asset Management, explained, AWS is their growth engine, and to see that drop in margin is dropping the stock. The market was expecting AWS to deliver even better results, propelling Amazon back to new highs. It's worth noting that AWS represents only a small fraction of Amazon's total revenue, but plays a pivotal role in driving profits, typically contributing about 60% of Amazon's overall operating income. Despite investing billions into AI infrastructure, AWS hasn't managed to develop a strong AI model, raising concerns about its competitiveness in the rapidly evolving AI landscape. Interestingly, while Amazon's cloud computing results were underwhelming, other segments of the company showed positive signs. Online store sales grew by 11% to $61.5 billion, and advertising sales, a rapidly expanding sector for Amazon, increased by 23% to $15.7 billion. These figures suggest that Amazon's core retail business remains robust. However, there's another layer to consider. Both Microsoft and Google Cloud are investing heavily in data center capacity to meet surging demand, especially for AI software deployment and development. Amazon, on the other hand, expects its spending to remain roughly the same as the second quarter's total of $31.4 billion, hinting at a full-year expenditure of around $118 billion. Analysts had projected about $100 billion, indicating a significant investment strategy. CEO Andy Jassy addressed concerns about the potential impact of tariffs on Amazon's core retail business during a call with analysts. He stated, "Through the first half of the year, we haven't yet seen diminishing demand, nor prices meaningfully appreciating." This reassurance comes as President Donald Trump's tariffs continue to create uncertainty in the retail sector, forcing companies to navigate a delicate balance between protecting margins and maintaining consumer demand. In conclusion, Amazon's cloud computing results, while not disastrous, certainly left room for improvement. As the tech industry races toward AI dominance, how Amazon positions AWS in this competitive landscape will be crucial. What do you think? Should Amazon accelerate its AI investments? Or is the current strategy sufficient to maintain its market leadership? Share your thoughts in the comments.